Welcome back to the Daily Crypto Deep Dive. Right now, the market feels heavy. Prices aren't breaking out the way people hoped. Rallies fade quickly, and every green candle feels fragile. Sentiment across social platforms swings between forced optimism and quiet frustration, and even long-term holders are starting to question timelines. When you sit inside a stagnant market long enough, doubt starts whispering louder than conviction. But here is the uncomfortable truth that history keeps proving. What you're feeling right now, this uncertainty, this slow grind, this psychological fatigue, is mild compared to what some early crypto participants experienced. We're not talking about watching your portfolio go sideways for 6 months. We're talking about watching something you once owned turn into generational wealth without you. Today isn't about laughing at people who sold too early. It's about perspective. Because when you zoom out, the real pain in crypto hasn't been drawdowns. The real pain has been selling, and then watching an asset you once held multiply beyond imagination. Let's start with the story that built modern crypto folklore. In May 2010, Bitcoin was barely an idea. It wasn't on financial television, it wasn't part of macro debates, and it certainly wasn't viewed as digital gold. It was a niche experiment discussed in obscure online forums by developers and libertarian thinkers who believed in decentralized systems. A programmer named Laszlo Hanyecz offered 10,000 Bitcoin in exchange for 2 pizzas. At the time, those coins were worth roughly $40. The transaction wasn't reckless or foolish, it was innovative and symbolic. It proved that Bitcoin could function as a medium of exchange in the real world. Now consider what happened over the next decade. Bitcoin rose from cents to dollars, from dollars to hundreds, from hundreds to tens of thousands. At the 2021 peak near $69,000, those 10,000 coins would have been worth close to $700 million, nearly $750 million for 2 pizzas. It's easy to laugh at the number today. It's much harder to imagine the psychological weight of watching that value grow year after year. Every bull run would have reopened the calculation. Every headline about new highs would have quietly reminded him of what once sat in his wallet. And here's the part most people miss. At the time, it didn't feel like a mistake. It felt like progress. It felt like participating in something new and exciting, not forfeiting generational wealth. Now move forward to 2013 and consider a different kind of loss. James Howells mined Bitcoin early and accumulated 8,000 coins. At the time, Bitcoin had already appreciated significantly, and those holdings were worth several million dollars. Then, in what would become one of the most infamous accidents in crypto history, he threw away a hard drive that contained the private keys. Initially, the loss was painful but survivable. Millions of dollars are life-changing, but they are not incomprehensible. However, as Bitcoin continued its ascent through successive cycles, that number began to transform into something almost mythological. At peak valuations, those 8,000 coins represented hundreds of millions of dollars. Imagine living with that knowledge. Imagine seeing Bitcoin's price on the news and instinctively multiplying it by 8,000 in your head. Imagine knowing that your financial reality could have been permanently different, but for one discarded piece of hardware. Now let's talk about Ethereum, because the psychology there was even more complex. In 2015, Ethereum launched its initial coin offering at roughly 30 cents per token. Many early participants put in small amounts of capital, sometimes just a few $100s. It was a speculative bet on a young developer named Vitalik Buterin and the idea of programmable money. When Ethereum rose to $2, early investors felt brilliant. That was a 6-fold return in a short period of time. For many, that was more money than they had ever made on an investment. When it hit $10, the gains were extraordinary. A small allocation had turned into something tangible and meaningful. Selling at that level felt rational, disciplined, and responsible. Then Ethereum kept climbing. It crossed $100, then $1,000. Eventually, in 2021, it approached $5,000. A $1,000 investment at ICO prices would have been worth millions at the peak. Now, pause and consider the emotional sequence. First excitement, then validation, then satisfaction from locking in gains. then disbelief as the asset continues higher, then regret as the scale of what could have been becomes visible. Selling at $10 wasn't stupid, it was human. And that is what makes crypto uniquely psychologically violent. Now consider Dogecoin, a coin born as satire. For years, Dogecoin traded below 1 cent. It was tipped on forums and treated like internet humor rather than a serious financial instrument. Early holders accumulated large amounts for almost nothing and rarely viewed it as a long-term wealth vehicle. When Dogecoin reached 1 cent, that alone represented enormous percentage gains for early participants. Many sold at that level, believing they had captured the full absurdity of the move. After all, how much higher could a joke go? Then 2021 happened. Elon Musk tweets amplified attention. Retail traders flooded into the market. Dogecoin climbed to 73 cents at its peak, representing a 73-fold move from 1 cent. Those who sold at 1 or 2 cents did nothing irrational. They locked in huge percentage gains on a meme coin. Yet the scale of what followed rewrote the emotional narrative entirely. Now let's bring this into a broader pattern. Bitcoin crossed $100 in 2013, and many early adopters exited. That price level felt absurd compared to where it started. It felt unsustainable, overheated, and clearly bubble-like. Some sold at $200, some sold at $500. Many believed $1,000 would never hold. Bitcoin eventually surpassed $60,000. Think about what that does to long-term psychology. Selling at $100 might have paid off debt, funded a business, or changed someone's short-term life. But watching that same asset multiply another 600 times can reshape how you think about risk forever. Now consider Solana. In 2020, Solana traded under $1. Early adopters saw it as a high-risk alternative to Ethereum, with faster throughput and a different technical architecture. Many bought between 50 cents and $1. When Solana reached $5, early holders felt rewarded. That was a 5-fold return in a relatively short period of time. Selling at that level seemed sensible and prudent. Then Solana surged past $50, then $100, then over $250 at peak. A $10,000 allocation under $1 would have grown into millions. And yet Solana also crashed more than 90% in the subsequent bear market. That is the second half of the psychological equation. Holding through gains requires enduring massive drawdowns without losing conviction. You might be frustrated because your portfolio hasn't moved in months. You might feel like the market lacks direction, or that capital rotation is slow and confusing. You might question whether you should rotate, de-risk, or wait. But historically, the most devastating financial pain in crypto has not come from stagnation. It has come from exiting too early and then watching exponential growth unfold without you. That regret can last years, sometimes decades. The lesson here is not never sell. That would be irresponsible and simplistic. The lesson is that volatility cuts both ways, and conviction is tested more by upside than downside. When assets rise tenfold, most people sell. When they rise 100-fold, almost no one is still holding. The market transfers wealth from the impatient to the patient, but patience in crypto often feels indistinguishable from foolishness while you are inside it. That is the paradox of this industry. Right now, it feels hard because price action is uncertain. But imagine the psychological strength required to hold Bitcoin from $100 to $60,000. Imagine holding Ethereum from $10 to $5,000. Imagine sitting through 80% drawdowns and still believing. These stories are not about luck. They are about time horizon, emotional control, and tolerance for extreme volatility. And that is why today's discomfort, as real as it feels, is not historically exceptional. The market has always felt hard in the middle. It has always felt confusing before major expansions. It has always tested conviction before rewarding it. And the people who sold too early didn't fail because they were ignorant. They failed because the magnitude of future growth was unimaginable at the time. That is the part that makes crypto unique. You are not just betting on price movement. You are betting on whether you can endure the psychological strain of holding something that might 10x, 50x, or 100x. while it constantly tries to shake you out. So yes, the market feels difficult right now. It feels slow, frustrating, and uncertain. But compared to watching an asset you once held become generational wealth without you, this phase is survivable. History doesn't reward comfort. It rewards endurance. And if there is one thing these 10 stories prove, it is that the hardest part of crypto has never been buying. It has always been holding. Make sure you are following the show. And as always, we will see you at the top.